Good evening, everyone, and thank you for joining us for our seminar this evening on mortgages. Just a brief introduction. My name is Jean Joe, and I'm the broker and owner of Perisson Real Estate. Perisson actually comes from the Greek word for abundance and overflow, and we really believe that we do live in abundance, especially here in the Bay Area, and our company's vision is to serve our clients so that they may thrive and experience abundance in their real estate lives. These seminars and webinars are an outflow of this vision that we have. We do want to provide value to others around us, whether it be our clients, whether it be the community, or even other agents. So we have invited other agents to join us for this because I think the more that we are aware and educated, informed, the more it is really a win-win for everyone involved. So just a quick outline. First of all, I'll do a very quick real estate market update. And then we will just go ahead and launch into our main topic, which is mortgages. And our speaker, Alan Kirth, has come up with this creative title, Behind the Myths of Advertising. So I think you'll find it very informational and interesting. And then I have a few announcements after that, and then additional time for question and answers if we do have time. So for the real estate market update, this is a question that I get asked very often. I've basically, ever since I've been in real estate, this is a common question that I get asked: how's the market doing? And even now, even more so now, as many of you know, we've actually had increasing rates, increasing prices over the past 7, 8 years. And last year we had this advent of the coronavirus. And there was a big question mark as to how, what would happen with the real estate market. A good picture of that is shown here in number of sales of single family homes in San Mateo County. So as you can see here, this first, starting from the beginning, this goes back 3 years. And we see in 2018, usually at the beginning of the year, it's a little bit slow as we start and getting over the season, holiday season. And you see that it goes up quickly. This is our traditional spring market that we see. And then it starts kind of going down a bit, slowing down. And then late summer, usually late summer, early fall, it is a little quieter. And then we do have another peak of another fall market peak. And then it goes back down for the seasonal holiday season, mainly because less people are putting their homes on the market. They're going to wait maybe for the new year. Don't want to have people coming in and out of your house, or don't want to worry about moving during the holidays. In 2019, we see that same trend going up gradually for the spring market, a little bit of a dip here for the summer, late summer, early fall market, another bounce back up for our August fall market, traditional August fall market, and then coming back down. For 2020, we saw it starting to rise up like normal. And then as you can see here, there's this dip, and that is, I don't think anybody would have a problem guessing that this is when we had the COVID shutdown. And so from here, during this time, it was actually a little bit scary because we weren't sure what was going to happen. We weren't allowed to show homes that were occupied. We were not allowed to do open houses or broker tours anymore, and we still are not allowed to do that. So it was not clear what was going to happen for the direction of real estate. Thankfully, after about a month or two, we started having more guidelines and understanding the issues a little bit more. So while we still can't have open houses, everything else is pretty much gone back to normal in the sense that we can show homes whether occupied or not. There are a lot of protocols in place to provide for COVID safety, COVID hygiene, and a lot of guidelines. But notwithstanding, what we lost in that spring market traditionally came back in the summer. And that dip we had a little bit, but not significant. And actually, we had a very strong fall and even winter market. So this past December was, compared to other Decembers, was actually very active and a very strong market that we had going on. This is a comparison, just looking at San Mateo County. We get to see what the first 4 months of the year traditionally have done, or compare this year, how we're doing so far compared to the past 2 years. So the lines that you see here in orange are 2019, which is our last quote unquote normal year. And so you see, basically the listings are here, kind of steady along, and then we see a rise toward the end of that, toward March, April, we start seeing more listings coming on the market. Contrast that, the blue is actually last year, and you can see it pretty much followed the same numbers and patterns as the year before, but then we have this steep drop right here in the middle of March. And again, everybody knows that's when the shutdown happened. And so there were still listings going on the market, but significantly lower than would have been expected, because people just didn't know what to expect and whether it made sense. And many people were even thinking about maybe holding off on selling altogether until things calm down with the with coronavirus pandemic. And then here, the green, we see these are new listings coming on the market. Starting from January and through this year, you can see that the numbers have actually topped other years. And so whatever people may have held back over last year, we're starting to see that movement again. So definitely a lot of activity. But with those increased listings, we're also seeing, this is now pending listings, which is places that have accepted offers. We see that, again, the orange is 2019. So we see increasingly as the year goes on, as the spring proceeds, that was going up. And then the blue shows that drop that happened with offers coming in, people putting offers on houses, getting accepted. All of that dropped significantly last year. And now, starting off in 2021, we're seeing this increase overall. So people are not able to travel or go anywhere. The holidays, all of that has been dampened a lot. And so the activity of these houses going into contract is pretty much almost in line with the houses that are going on the market. And then this is this number of sold listings. So of course, those are going to lag behind. The closed sales are going to lag a little bit behind in terms of time when you get an offer accepted, and then maybe another 30 days, 30 days out. So you can see that the patterns of 2019 and 2020 were about the same until we got to near the middle of April, because that's when we started closing out the things that went into the homes that went into contract before the shutdown happened. And then again, we're seeing so far it's been the number of closed sales. It did go down a bit just because, again, the holidays, and there is a little bit of a decrease, but the numbers are still higher than what they were in the previous 2 years. Here's a look at the the months of inventory. So months of inventory has to do with how many, if you were to take the number of houses that are on the market and were to evaluate how long it would take to sell all of those homes at the current rate, at the current selling rate, then how many months would you have? So if it's at 6 months, that's considered a balanced market. And then over 6 months is considered a buyer's market, because it means you have a lot of inventory. It would take you a long time to sell it all. Under 6 months is considered generally a seller's market. And as you can see, the top of this graph is actually at 3 months. So we have not, in the past 5 years and longer, been in a place where the inventory was ever over 3 months, and even 2.5 months. We did have a little portion right here. This peak here that you see is March and April of last year, which again makes sense. So other than that, as of last month, we're still, and even now, we're at about 1.5 months of the inventory. So it's been a solid seller's market, regardless of all the different news that we're hearing. And this, because of this is one of the main reasons why the market has remained strong. That and interest rates as well. So just consider, to put this into numbers, inventory is very low. So we have in Millbrae right now only 6 active listings on the market. And just taking that in, usually we'll see maybe 20 to 30 at a time, but only 6. Yesterday it was 4, so we had 2 more come on today. In San Bruno, 13 active listings in the entire city. San Carlos, 11 listings in the entire city. So inventory is very low, and it is quite competitive right now. Because of that, the median sale price has been continued. It has been on a continued trajectory upward with some ups and downs. We had in January 2016, it was at 1 million. And then since then, it's continued to go up. And last month, We were at Last month, we were at 1.5 months, $1.5 million as the median sale price. So prices have continued to remain strong, even in the midst of this. And you'll note on this graph that on this chart that we see the peak here in August of last year, that was an all-time high of median sale price. It was a little over 1.7 million. And that shows you, even in the midst of the pandemic, we were actually hitting and exceeding all-time highs in terms of the median sale prices. So in the field, I just wanted to close out this section by sharing a little bit about what we're seeing, just boots on the ground in the field. The market, as I said, is very competitive. The demand is still high, despite all of the news that you may hear about an out-migration from the Bay Area. First of all, part of it people think is temporary, that there are some people who maybe for the short-term remote working found that they can actually live elsewhere for a little bit. But even with people who are leaving, and I am seeing some people leave the area, the amount of supply, the shortage of supply has been an issue for so long and the builders are not building fast enough that we still do have a great housing need. And so right now what we're seeing, I have a listing in Pacifica, went on the market last Friday, and today is Wednesday. Within 5 days, we've actually gotten already 7 offers, and we'll be going significantly over asking and even significantly over what I believe the market value would have been. And I'm hearing this from all the agents that I'm speaking with all around in networking, and buyers agents especially, that it's been a difficult time because we're getting, people are seeing 20 plus offers, 5 to 10 offers, a lot of offers coming through in terms, and it's very competitive. And in many situations, even some agents who are trying to, or buyers who are trying to put in an early offer to be able to have an advantage or be able to get it before any other offers come in. So it is competitive. I would say for the sellers, it's a great time if you strategize correctly, price correctly, and present well. Definitely do virtual tours, because that's important to do before people actually come visit the home. And then for the buyers, it is a challenging time. I would say don't give up. It's still a good time. And it's still a wonderful place to live, and the interest rates are great, and we'll be hearing about that more, but the mortgage rates are great. There are a lot of opportunities, but it can be a challenge, and it will require a little bit more patience and a lot of guidance. So we'll go ahead and launch right into the mortgages section. I'm going to turn this over to Alan Kirth. Alan has been in the mortgage business for over 35 years, both residential and commercial lending. And he is a great resource to have. He's one of those people who he loves talking about mortgages and loves educating his clients on mortgages, which I think is fascinating, because it's hard to find people who it's not the most exciting subject, I would say, but he does love to help educate his clients. He does speak regularly at our Realtor Association meetings, and explains what the rates are doing. And I think you'll find a lot of helpful information through his seminar. So through what he's going to say.
So first of all, I just want to thank everybody for being here, and I hope you're having a nice glass of wine, and are not missing the wonderful basketball game that's going on for me. So let's kind of move right into behind the myths of advertising. Because I need to move the screen. We all see the advertisements on TV and hear the radio pitching at us. No points, no lender fees, no closing costs, unbelievably low rates. How does that all come about? Are they real? Well, the answer is they are for a minute, because that minute in time, appreciate that, radio advertisements, television advertisements take time to produce. Is it real that the rates would remain exactly the same? No, they change every single day. So, and the other truth is that there's no such thing as no costs. Every loan has costs. So let's move to looking at that. Every lender has origination fees. What are origination fees? underwriting fees, loan processing fees, maybe an application fee or documentation preparation fee, tax service fee, and flood certification fee. These are all things that the lender pays for, has you pay for, so to speak, that were from old times, really. Lenders used to have all these extra charges, but then the federal government took it away and said, well, you have to call these loan origination fees. So now they may list them, but they all come under the heading of points, so to speak. They get included in that section of loan origination fees along with points, but they're separate from points. Now, when a lender tells you there's no lender fees, that's quite a bit different than no fees. What they're saying is, oh, we're not going to charge you all these fees. Instead, we're going to put it all in the points. You just don't see it. It's smoke and mirrors. So the reality is that there are always lender fees and lender charges because there's always lender cost. So the reality is it's baked into how they charge you. Anyway, moving on right along, what's more important is to look at are third-party costs, which cannot possibly go away. Because the lender has to get an appraisal from an appraisal management company. They're a third party. The appraisal management company concept was brought up by the federal government to protect you and me from having direct contact with the appraiser. So it would protect the appraiser from being forced to deliver a value of whatever type. So this concept of having third-party costs, the lender has to pay for the appraisal fee, the appraisal management fee. Actually, you have to pay for it. You have to pay for the credit report fee. You have to pay for the escrow services, and these are title services. Title services are their own costs, regardless of where you go. National services may, in fact, sometimes have lower fees, but then again, there are also national services that may not have the same level of service. Certainly it may not be your local title company that you may know the escrow officer or the loan agent may know them and have a relationship. And I think what you're also going to find if you checked through different title companies like Old Republic Title versus Fidelity National or Chicago Title or Lawyers Title, whatever, those title fees vary minimally from one company to the next. And they are charging title fees. You can't eliminate them. You can't eliminate a notary fee because that person that comes out to your home and signs you, they need to get paid. The lender's not paying them, you are. Recording fees, that's the county and the state, by the way. So the state adds their own little cost on. But the reality is that it's a third-party cost that does not go away. So if we actually looked at all of these third-party costs, loan origination fees, and not points, non-point cost, loan origination fees, and third-party costs. Reality, every lender, I don't care who it is, whether it's me, ABC Mortgage, Chase, Citibank, Loan Depot, whatever, it's going to be an average of like $3,000 to $4,000. Smaller loan amounts will tend to have a little bit less. Sometimes you might get an appraisal waiver where the appraisal is actually waived and you don't have to have it. That's a savings. That cost goes away. So that might be a lower end cost on the $3,000 category. But for the most part, I think $3,500 as total cost beyond points for every lender is about right. It's an amount you should look at as being real. So whenever you're looking at loan charges, you want to look at the loan points are, what the rate is, and look at closing costs, third-party provider costs, and lender origination fees as a separate item. So we're talking about, are the advertised rates real and what affects them? If you ever look at the fine print on one of those ads, you're going to see that there's a very specific loan amount they're using. It's not going to be a range. It's going to be a specific loan amount. It's probably going to say that it's a rate and term refinance because they're not going to advertise a cash out refinance. Why? Cash out refinances have a higher cost across the board. It's a Fannie Mae and Freddie Mac loan level pricing adjustment, so it's national. It affects everybody, not just any one specific lender. So it's going to be a rate and term refinance, and the loan amortization period, the term of the loan, is going to be a very short period, especially if they're advertising just a low rate. Why? because those are the lowest rates, the shortest terms. It may be a 10-year fixed, but they're not telling you that until you call them. It may say that in the fine print that it's a 10-year fixed, but that's going to produce the lowest interest rate and how they're able to offer those low rates. So lowest rates usually equal the shortest term loan, which, by the way, translates to the very highest monthly payment, and of course the highest cost. What you may not realize when you see those low interest rates is that the cost that goes with them to create that rate might be in the category of 2 and 3 points. That's how they're offering the low interest rate. The APR comes out being lower than a loan that has less points, because APRs generally talk about how quickly you can pay off the loan, the recovery of that rate. So it really reduces it down to an overall cost. We'll talk more about APRs in a little bit as well, but I think the reality is that these are what you're going to see in ads, and they are not real rates. They would not fit every borrower. So let's move to next. What fits borrowers, I think, really fits with your lifestyle. What fits you as an individual. It's not about going on to seeing what rate is advertised or going into the local bank and seeing that they have, 2.25%. It's about finding out what fits you, what fits your lifestyle, what term of loan. I hear so often, here's a common comment, if I refinance to a 30-year loan, I'm starting all over again, aren't I? No, not really. When you think about a 30-year term of loan, you're thinking instead of what is the longest term you're allowed to repay that loan in. That's reality. If you pay $1 less per month, you're late. But you can pay $1 more, and guess what happens? You change the amortization period. Simply by paying $1 more, that loan's no longer a 30-year loan. So what I'd like to talk about in terms of people refinancing is, instead of, it depends on age and what their goals are, obviously, but instead of thinking in terms of reducing my payment per month, maybe instead reducing your term of loan. Refinancing has a much better effect when you reduce the term of the loan than you do by reducing your payment. As a matter of fact, if you probably took a comparison of a much lower rate than your own loan, and you had a reduced payment, but you had 23 years left to pay, and now you're back at 30, you're probably going to pay more for that brand new lower interest rate than you are for the loan you currently have in the long run. However, during that term of the loan, you're going to enjoy a lower payment. So who would that fit? Answer, maybe retired people that are living on a fixed income. A retired person living on a fixed income may not care about how much their loan cost is, or how fast they pay off their loan. They care about how much money they have in their pocket at the end of every month, and they want to be able to live on that money for as long as they possibly can. So those people are going to probably choose a 30-year fixed rate loan. Who should choose 20-year loans, 15-year loans, 10-year loans? The answer, people that can afford them. That's the simplest way to look at it. I had a client come to me that, believe it or not, had a $25,000 monthly retirement income. And he could easily have a 15-year loan. And yes, he was 73 years old. And he's like, well, it doesn't make any difference to me. So he gave him the lower interest rate. He could have paid the loan off, but for him, it made sense. But for somebody else, it may not. So I tend to think in terms of, it really, you have to look at what your term is, what fits you, your age. If you're 35 years old, 40 years old, and you really don't plan to invest in other real estate, doing a 15-year loan can make perfect sense. You have an age at which you're going to be earning a good income, and man, you've just got the ability to pay that loan off in a reasonable time. Notice I said you're not planning to invest in other real estate. Why? Well, if you got a 15-year loan and you want to qualify for something else, you're going to have a much higher payment. obligated payment that you'll have to qualify with when you're trying to buy something else. And then think about the 30-year fixed rate loan for those older people that maybe their 50s that go, well, gee, I want to pay my loan off in 15 years so that when I retire, I'm 65, I can collect my Social Security or whatever age they want to do that, get my Medicare, and my loan's gone, right? Well, what we don't plan on is maybe when they're 62 years old, they have a health crisis and or they lose their job. Maybe having that 15-year loan wasn't the best concept. Maybe they would have been better off having had a 30-year loan and having paid it on a 15-year amortization period. Or you get the idea of that, I think. Rocket Mortgage, I love Rocket Mortgage because they have really, truly done the best job of marketing in the world. Their overall closing percentage of loans is a percentage that would amaze you. It is so small, but yet their appeal to marketing is absolutely amazing. They've attracted literally hundreds of thousands of people every single month applying to them. And they only take the cream of the crop and what fits their model. So the reality is a lot that goes away because it doesn't fit the model. That is actually a standard model that every lender has available to them called Fannie Mae Day One Certainty. Fannie Mae, Freddie Mac offer a product that is a kind of an automated approval process where if you're working for an employer that gives us a verification of employment immediately, or maybe you get an appraisal waiver, or maybe you sign up to have your account looked at where we can go into your account and get a 60-day picture. The Fannie Mae automated system will actually give you an approval right now, immediately, whether I submit it or Rocket Mortgage submits it. And you may not have to get any income verification at all. No, no appraisal, no asset verification, because it's already done kind of on an electronic basis. But they've made a point of selling it. And that's what they do. That's what they attract. And now they're attracting a commercial that says Yorgage. What does that mean? It means choose your term. If you want a 15-year term, we'll give you a 15-year term. You want an 18-year term, we'll give you an 18-year term. But is that really benefiting the customer? I say the answer is no. Because if the customer would be better suited by having a 30-year amortization and paying it on a 23-year basis, remember that if they stop paying it that way, they can always go back to paying the 30-year term. It's their option. But once you're obligated to that 12-year term or 15-year term or 18-year term, you're done. There's no going backwards. And what we're going to learn in this process is it's just a cost difference. It's not really a rate difference. We always talk about rates going up and rates going down, but that's not reality. Reality is that cost goes up and down. Points go up and down every single day. The rates stay the same. Explain to me how 3.375 changes from day one to day two. It's still 3.375. But we might find the cost of 3.375 to be a different amount of points. And we'll get to that in a little bit. So I'm going to say don't limit your options and recognize how age plays a role in your choices and goals. And speaking with a professional can help you choose that right niche of what's going to fit you for the right loan and your affordability. It worked. I'm so amazed. So now we're going to look at real-time rates and points and maybe take a vision of what I see. When you go to a bank or you see the rates advertised on a little screen, you're pretty much only seeing one rate. When you hear it on TV, you're seeing one rate advertised. And that's not reality. There are many different rates available every single day to every one of you based upon their cost. So what are points? Points are an upfront origination cost. Each point represents 1% of the loan amount. Do people generally pay points in a refinance? Yes, they pay points. Do they pay them out of their pocket? No, not typically. Most often we add them to the loan amount, so you're not really paying cash. You can. To me, it doesn't make that much sense. but it's your option. It depends on your affordability, you know. What are rebate points? Interesting. You know, there's a whole spectrum of rate and cost available, and we're going to see that graph in just a moment of what those rates are. But rebate points are like points. Instead of being a charge for a percentage of the loan amount, it's a rebate to you at closing for a percentage of the loan amount. So that rebate goes on your settlement statement, showing you that it is a credit to your closing costs. Now, the only thing I'll add is that you can't have more credit than you actually have closing costs. So you have to have the closing costs to pay. And they can be recurring fees, which means taxes, insurance, and prepaid interest. So we have non-recurring costs that I talked about earlier that were all those $3,500 of costs and points. And we have recurring costs, which are your costs: property taxes, insurance, and prepaid interest. So the more points you pay, the lower the rate you're going to get. The more rebate points you get, the higher the rate you're going to get. And that does affect APRs. The highest APR is going to be the loan that has no cost. The lowest APR is going to be the loan that has the most points charged, because it reduces the overall payment of the loan. Even though you've included that cost of the loan in the loan, the overall payment is less than it would be at a lower cost amount, which is why many retired people that have lots of equity and are living on a fixed income, they're the ones that will see pay 2 and even 3 points if allowed. I got to tell you, the federal government actually limits our ability to charge you. We really can't get above about 2.9 to 3 points, depending upon the loan amount. And in some cases, it gets cut back to maybe even 2.75. Non-owner loans we can go higher on. We have more limitation because they don't fit into the same ID concept as that owner-occupied residence. You're more protected, so to speak. The government wants to protect you more. So anyway, moving right along. See, this time it didn't work. There we go. Now let's take a look at this. This is interesting. So look at this is what I actually see. When I pull up interest rates, and this loan amount is a $510,400 loan amount, and it was actually a loan that I looked at the other day for one of my clients who had refinanced 6 months ago. And he has 2.5% 15-year fixed. So you may be asking, seriously, the guy's talking about refinancing? Does it make sense? Well, here's what I got when I pulled up 15-year fixed rate loans. I got 1 point. Now, by the way, rates are higher today. We had a jump in market on Tuesday that wasn't very friendly and wasn't very fun. Hopefully it'll come back a little bit, but these are last week's rates. So the 1.75% rate, so you see the rate column, goes with 1.583 points, which equals, on a $400,000 loan amount, $8,079.63. Those are your points. And then you see the payment over here. Take a look. It's the lowest payment on the grid, right? And we move down to the next step and we go higher in rate. 1.875 is at 1 point. 2%, 0.463. Now we go into rebate. We can get all the way down to, look at that 2.5% with $8,000 of rebate. But would you have $8,000 of cost? Well, if you had your property taxes due, yeah, maybe you would. You have insurance due, maybe you would. You certainly wouldn't have that much cost, because the cost is usually about $3,500. So that's the one-time cost of a loan. So you really have to be more in the category of, say, the $4,300 or maybe maximum of $6,600 to be able to take that rebate. And then the question is, why would you? Well, look at that $8,000 one for a second. That might fit somebody buying a property that's really limited in down payment. Let's say they don't have a lot of cash, but they qualify. They have a lot of affordability. They have a great income. That's a good loan for them. So it's all about what fits what people. Moving to the next slide. When we talk about refinancing, we also talk about whether it makes sense to you. You know, the old school method, when rates were 7%, and maybe you had the possibility of moving to 6%, that's a 15% difference, folks. Not a very big difference. You know, the amount of principal that gets paid in a 6% loan compared to a 7% loan isn't that big. But when we move from 4% to 3% or 2.5%, it's a big difference. You're talking 25% or more difference in rate, and a huge difference in what gets paid in principal in the loan. So in the old school methods, we used to look at the cost of a loan. Let's say the whole cost of the loan was $10,000, and somebody would save $200 a month. Did it make sense? So they take the $10,000, they divide it by the $200 a month, and it equals a recovery period, right? What's that recovery period? Is it 50 months? I think it is. So in that example, if somebody were getting their money back in 50 months and it made sense to them to refinance, they might have done it. But that method doesn't work today because the differentials are too big. So let's take a look at how we can compare them. That's that same grid. I've taken out a few pieces of it. Okay. So here's what we're going to do. We're going to convert the cost right here, that $3,500 average cost of loan, which are the lender's one-time upfront fees. We're going to add them to the points for the total cost. And then we're going to convert that total cost to a percentage of the loan. Because think about it in real terms. You're paying X percent of the loan, in this case, 1.784% of the loan, upfront. For what kind of return? So this will show you the return. So all we've done is we've taken the percentage of points right here. We've turned this cost into a percentage of points. We've added it to the points themselves to create the total cost. And now we have the total percentage simply by taking that total cost and dividing it into the loan amount. That's how it's done. So I'm going to move my face because I can't see over here. Anyway, so now we have the years to recover and the rate savings. So here's the example. This person had a 2.5% rate, and we're comparing it to 1.875. So their savings was 0.625% per year. So what do? We divide the 1.784% upfront cost one time by the annual savings. And in 2.854 years, that person is recapturing their cost. I want to bring us to a level of different understanding, actually, so you can really see what's going to take place. If we take that $510,400 loan amount and we add that $9,100 of cost to it, so we're going to do a $519,100 loan amount, right? If we looked at their current loan, this man's current loan, and by him making his current payment, if I look 2.85 years into the future, I could tell him exactly what his loan balance is going to be. It's amortization. We know what the balance is going to be. Simply by knowing here, he makes X payment at X interest rate over X term, bam, in 2.854 years, here's what he's going to owe. If that person makes the exact same payment he makes now on this lower interest rate loan, higher loan amount, even though we've added $9,100, guess what? In 2.854 years, his loan's going to be down to the exact same balance it would have been on the existing loan. That's what we call a break-even point. He literally breaks even. I want you to think about breaking even in different terms as well. It's like going to Tahoe, right? Let's say you have $500. You went to a gambling table. You put it on the gambling table. You lost most of your money, but you didn't lose all of it. And you sat there and you gambled and you gambled and you gambled. And you start winning it back, and you get it all back. That's 2.854 years. You didn't win anything. You're not ahead of the game until you break even. And then once you've broken even, you're now ahead of the game. You're going to pay that loan off faster as a result of that. So that's what breaking even really means in these terms. When we use these terms of years to recover, that's the experience you can have. So now let's go to these other concepts and let's see how they affect us. Look at the 2% interest rate and how it has a 2.297 year recovery, and 2.125 has a 1.394 year recovery. You recover faster because your cost is less. And then we go to the bottom line, 2.25, where the man's actually getting overall, end of the deal, $879 more credit than he's paying. Look at that. It's not only a no-cost loan, it's no cost plus the lender's paying some of his costs. So this actually becomes the time period that takes the lender to recover their cost. That's reality, because there is no cost at all, no cost to recovery. So that's what I want to point out. So if you're a believer that interest rates will go down further, maybe you'd be somebody that would want to do a no-cost loan. Let me tell you, with instruction and choice, many of my clients over the last year and a half have done no-cost loans with the total intention of waiting 6 months. This man did a no-cost loan with the intention of doing this, exactly what he's doing, in 6 months. And yes, he locked in this time to the highest cost loan. So we did no cost loan because it made sense. I will add to that if you've refinanced a loan, you really shouldn't pay that loan off within 6 months. It's not fair to the lender. We as lenders have what's called early payoffs that we have to pay. All of our compensation is taken back by the investors that we sell these closed loans to, if that loan gets closed and paid off within 6 months. And if you even came to me and you had done that, even though it was another loan agent, I wouldn't do the loan. I wouldn't put the other loan agent in that situation. So which is why we look at every 6 months at reviewing the client's loan. But anyway, this kind of just gives you a basic idea of what that no-cost concept means. And it also tells you how lenders can advertise no points, no fees. Make sense now? It's actually done with a rebate. But what I really want to point out is that never again should you not find out exactly what the points are. So often somebody will come in, well, the lender's offering me 2%. What are the points? I don't know. They told me it cost me, $500. That's just not reality. What lenders use is the loan estimate to sell you. So, and that's not what it was designed to do. So the loan estimate is being used currently by lenders as a sales tool. The real purpose of the federal government having created it was instead to have it compare your costs from the beginning to the end. Remembering back in the day, loan people could tell you the cost was one thing right now, and then after get to the end of the loan, gee, I'm sorry, but this happened, that happened, rates changed, and yeah, maybe your points went up or your rate went up, but let me tell you what really went up: what the lender was making. The lender's earnings went up because they changed your cost. We can't do that anymore. I never did it. Doesn't matter whoever did it, but lenders can't do it anymore. And they can't, and this tool, this loan estimate, was designed really for that purpose, to kind of lock us into what we disclose to you, so that when we compare it to the end, those costs don't change very much. So it's not to show you how much you're going to have to pay at the end. That's the confusion. People look at this thing and go, well, isn't it supposed to show you my closing costs? No. The only thing that actually is going to show you your closing costs is an estimate from the title company. So if you really want to know what your closing costs are going to be, ask your lender to provide you an estimate from the title company based upon the loan estimate that's been provided. That'll give you an idea of what your final closing costs will be. So let's kind of move on. If you look at some of the points here, so where are true upfront costs on the loan estimate? We're going to get to that. Where are what points and rebate points are in different places? I'm pointing these out because the next slide is the loan estimate, but I want you to kind of know what I'm going to talk about. So non-recurring one-time upfront costs in the loan estimate, where are they? And recurring costs, what are they? And what I really want to point out is that lenders use these recurring costs to fool you into making it look like you have less cost or more cost. Ladies and gentlemen, recurring costs are your costs. They are going to be your costs at lender A, lender B, lender C. They're not going to change. And whatever the lender shows you up front as that recurring cost can change because it's your scenario that changes it. Let me give you an example. Let's say when the loan estimate was put out, there were no property taxes owed. They weren't due yet, but then they became due. Guess what? If your property taxes are $4,000 every 6 months, you just had $4,000 added to your closing costs because they have to be paid. You can't pay them when you want to pay them. You have to pay them when the loan closes. So that's not going to be on your loan estimate unless the lender puts it on there in advance. And it's not going to be there unless it's due. That's just an example of how your costs can change. So moving on, let's take a look at that loan estimate. Whoop, I went too far. This is kind of hard to see, huh? I think. So I want to point out this is the second page, by the way, of the loan estimate. The first page shows you what your interest rate is, what your payment is, and it'll also show you what your property tax and insurance payments are. Not that you would have them impounded. You're welcome to have an impound account for taxes and insurance if you want, where the lender collects 1/12 of the property taxes, 1/12 of the insurance, and pays it on your behalf. All that money goes into a savings account, so to speak, held by the lender to pay it when it comes due. And that too is your cost. It's not the lender's cost. They're just putting an amount aside based upon how the numbers work out. But this breaks down where they come from. So the first thing is on a loan estimate are loan costs. And then the second part is going to be services you cannot shop for, which obviously would be appraisal and things like that. The lender chooses who the appraisal is going to be done with, who the credit reporting company is, who they use for a flood certification. And flood certification tells them where you are on the flood map, whether you're in a flood zone or not. And then services you can shop for. You're welcome to choose your own title company. You know, most often the lender has a relationship, and that relationship may be a good relationship for the lender, somebody they work with well. I know that I work with my escrow officer and they know me. They know exactly how I operate. They know what I want. And they know when they're in trouble too. When they haven't done something that I think is important. Because it's all about providing you the best service, right? So anyway, but you're welcome to choose your own. An example might be, let's say the lender tells you, well, they have this national title service company, but you go, I don't want to deal with that. I want to work with somebody local, somebody I know. You're welcome to do that. And when you do that, it takes the onus off the lender of disclosing it, believe it or not. When it's the lenders, they have to stick within these fees, actually within 10% of title fees. So what does that mean? It means if for some reason those costs change and they go above 10%, the lender actually has to cure the cost. That's the purpose of the loan estimate, is to lock the lender into these costs that they report to you so they can't exceed them later on, even appraisal fees. So an honest lender will probably quote you a higher appraisal fee, than a lower one, because they're telling you what the real cost will be to protect themselves too. So let's move on to other costs. These are the recurring fees, whether it's recording fees and transfer taxes, homeowners insurance. Again, they're all your charges. They're not ours. They're not a lender's.
Sorry about that. We've lost Alan for a bit. So while we're waiting for Alan to come back, we actually did break it down so that you could see a little bit better. You can see here the loan costs with the origination charges, processing fees, underwriting fees, and whatnot there. So this is a situation where we have the charge, the points that are being charged. And so you'll see here that the points that are being charged are $7,781. So that's where the points are showing up. And then this is the example of the services that you cannot shop for that are already included in it, and you'll actually be seeing it. And I see Alan is coming back in, but welcome back. I just went ahead and I gave them kind of the details of these two.
Oh, good.
Just because it's easier. And so.
Well, that was quick. Good for you. So, okay, so we were looking at, I take it do I have control yet again? Yeah, so now we see a loan with points, obviously, which this is where you're going to see points. Now, what's interesting is if you look back at that grid, if I can go back to the grid really quick. If you look at the grid, you're going to see that we have points and rebate points. So my question to you is, why did they design this? Because this is a cost of the loan, right? Rebate points are a cost of the loan, where you have the choice to choose from paying points or getting rebates. So why did they do it this way? Why did they make, back up, the points up here, but the rebate all the way down here? And how would you know the difference? That's my question. Unless somebody told you, this is where you find points and this is where you find rebate points. And this is how lenders are able to use all these little tools of confusion to their advantage in really you never really understanding what your rate and cost are. So again, I'll go back to that very beginning thought of whenever you're getting a rate and quote, don't just ask what the total cost of a loan is. Be specific. What's the rate? What are the points? And then there should be a number, a specific number, whether it's 1.05 or 1 point rebate 05, doesn't matter. There needs to be a specific number. So as we go through this really quickly, we're seeing these loan costs that remain the same. Again, items you can shop for, items you can't shop for. And then we see all your costs that we talked about. And then we see these total costs. In this particular example, we're looking at a cash out refinance. So that's supposedly how much the borrower was going to take cash out. So he paid all his fees. Now, this is a good example because I like this loan example. So who is this? This is a 69-year-old male who's widowed with a new person in his life. And he's refinanced to take out, as you see, $41,000, which helped buy a Tesla because it made sense. And he paid the absolute most that was available in closing costs because the interest rate was so low. And he doesn't care because the home he lives in is going to go to his daughter. And he hopes to live another 20 years. And he still doesn't care. The equity is tremendous. He already has a $2 million house with a $300-something thousand loan. I hope this makes sense to you. So anyway, just another example. Moving on. There we go. So now this is an example of a loan with rebate. There are no points. And we have to find them in that bottom section that we talked about. All the way down the bottom. If there's rebate points, they're down in that bottom right-hand section.
And just really quickly, there was one question about APR and interest rates. What are the differences? So kind of going through those examples, how would you describe that?
So if we go back to that slide, real quick, that APR, you're going to find the APR on this 1.875 rate to be the lowest. It's represented really by the payment. So if you look at what the payment is on that loan, it's the lowest payment overall. So it is definitely going to be the lowest APR. That's part of how it gets calculated. But in reality, the technical way an APR is calculated, watch this. They take the 5, 10, 400 loan amount. You subtract from that the points and what we call APR related items. So included in APR related items actually is prepaid interest, which is a kind of a trick of lender APR disclosure. I mean, if a lender uses 15 days of prepaid interest versus 30 days of prepaid interest, the APR is going to be lower. So APRs are not always, you really can't shop APRs. That's what I'm trying to tell you. APRs are not a fair way to shop because you're not really comparing rate and points. You're comparing the lender's way of showing you what the APR is. But what's really done is they take the 5, 10, 400 loan amount, they subtract all these points, and then they work the payment into that lower loan amount to equal an interest rate. That's called the APR. So that's how it's calculated, the technical way. But the end result is this loan has the highest APR, this loan has the lowest APR. So I'm going to skip the loan thing, the lender choice thing, maybe go back to that in a second. Let's go on to what's going on in the marketplace. Can I use a dollar amount to explain APR? I don't think this would be a good setting for that. So if you want to talk to me afterwards about it, I'd be more than happy to. If you want to talk to me individually, not a problem. So what's going to happen in the future? What's keeping interest rates down? Well, COVID's keeping interest rates down. The reality is people out of work, people needing to survive. Interest rates go down because they need to go down to help people. What else is keeping interest rates down is the federal government. A decision on the feds to reduce interest rates and to keep them down. How do they do that? The answer is they buy mortgage-backed securities. And the amount of money they put into mortgage-backed securities is greater than any amount you could possibly imagine. Last year, $1.5 trillion went into mortgage-backed securities. Amazing number. Daily, the mortgage-backed security marketplace daily, where rates really kind of generate from, the purchase volume daily at the mortgage-backed security desk tends to be in this market right now, $8, $9, $10 billion a day. So how much does the federal government buy? Ready for this? $5, $6, $7 billion a day. It's huge. So what's making rates stay down is them buying mortgage-backed securities. We had a huge bump I talked about yesterday. That bump was coupled by two things. One was inflation that's kind of eminent in the marketplace through hard materials, lumber, believe it or not, chips, semiconductors. There's a shortage of them. COVID's created a lot of shortages, and that shortage is creating inflation and at the core level. And the word inflation is a really bad thing for interest rates. That sets the mortgage-backed security marketplace off. So the fear of that inflation yesterday made rates kind of move pretty quickly. No, but not rates. It made cost move. It made price move. So, example, most points moved about 1 point in fee. That's a huge move. And that was coupled with the reason that the Feds that day only bought $3 billion. So what if they bought $7 billion that day? The answer is we wouldn't have seen as much of a movement. What's going to happen in the future? We really don't know right now. Are we seeing inflation? Because look at the bottom. Inflation is terrible for rates. It eats away at the future dollar. And that's the worst thing that can happen to interest rates. Recession is great for rates. Oh my God. The word recession means that we have the need for lower interest rates to come out of recession, to feed the economy with more income to be used in spending. And think about that for a second, what COVID's done. People are forced to stay home, right? They aren't going out to restaurants. They're doing online shopping, but their entertainment's cut down to nothing. They're not spending money on the Warriors games to go buy tickets. They can't get them. They're not going to all these things they would used to do. They've been forced to save money. So when we think about that factor right there, how much savings is going into the marketplace that people never did before, we're actually setting up for the potential of a very, very strong future. This may, I think we would have had a recession anyway if we hadn't had COVID. We would have had we would have gone into a major recession for economic reasons, and real estate may therefore have been affected. Why was it not? Simple answer: interest rates. Interest rates are so low that people have affordability to be able to spend that money on buying a home that they wouldn't have otherwise. And that interesting factor of people moving, even going to other places. Think about it this way: where their affordability maybe gave them affordability previously of a $350,000 loan, and the low interest rates now give them the affordability of a $450,000 loan. Well, they couldn't have bought a place for $350,000 out in the valley that they would have wanted to live in, but they certainly could buy one for $450,000. So they moved to the valley. It makes sense. And we're going to see those interest rates go up and that affordability go down as the economy gets better, which may impact real estate slightly. But then again, you have to ask that question: what's going to happen as a result of all that savings? And will the stock market be affected by higher interest rates? Answer is probably. So, end result: we have very, very high unemployment. One of my clients in the healthcare field, who kind of works with Genentech and for Genentech, just told me tonight, we're about to hit another strain of COVID, and there's going to be a resurgence. It's about to take place. We already know it. And my answer to her was, well, that's good for your interest rate. It's not good for the world, but it's good for your interest rate. So rates will probably come back. But take a look at this right here. This is the 10-year chart. Look at where it drops down in April and March, right in here. That's COVID. This is what made the treasuries go down. And then they got to the worst place possible. That was about 0.5, by the way. Treasuries were at an amazing low. And what you're seeing right now, that 10-year treasury moving up and up and up. Now, this is not mortgage rates, folks. This is the treasury. Mortgage rates come from the mortgage-backed security marketplace, one you don't see. And they don't move hand in hand. If they moved hand in hand, to be quite frank with you, rates would already be significantly higher than what they are. What made interest rates pop yesterday is this right here. That jump, where it jumped from about 1.15 up to about 1.3. It was like a rubber band. It broke the mortgage-backed security marketplace. They couldn't get that far apart. So the mortgage-backed security marketplace had to follow. I do believe the Treasury does have to come back a little bit for interest rates to stay in line, but I also believe interest rates will probably come back a little bit currently. We're not out of the woods. That's what I think. And then we have to look at how that's going to affect you, and how it's going to affect real estate. Will it, what and where will it change? We talked about the Valley, people moving to Texas. It's a big thing, but we actually don't see real numbers leaving California yet. That's what the U.S. Postal Service numbers say. Will it happen in the future? Well, the answer is potentially, because what is happening is we don't have the numbers rising in California. That's what's wrong. And our budgets are based upon future numbers, and they base those future numbers on people coming in. So I think we're going to see more and more supply problems, one way or the other, especially in areas that are lower priced. Opportunity exists right now in our area. Condos. Oh my God. The condos in our area are just taking a beating, so to speak. Would you agree, Gene?
Yep.
So that's an opportunity in our area. How long will it last? The answer is it'll last as long as we are having issues with our health and being stressed by COVID. That's about to change and go away. So here's what I'm going to tell you. In the end, you can turn your equity into real estate investments. You can take a cash out refinance. You can use that cash out to buy maybe a second home or an investment property, because you're probably going to see values continue to rise for a while, especially with that savings that we have, even if interest rates move up. That's my guess. We're going to see those values continue to move. Or remodel your home. Take that money out, pay off debt, reduce your overall costs. It's surprising. I recently took somebody that reduced their payments $500 a month, and they kept making the same payment they pay now, and they're paying off their loan, their car, their everything way faster than they could ever imagine, because they chose to amortize it their way. It's a 30-year fixed rate loan, but they're amortizing it their way. So what can these cash out refinances do? Well, they'll give you down payment for closing costs, second home, and maybe help you find those opportunities. But who's going to really help you find the opportunity? The answer is all the agents that work for Jean and Jean herself. So thank you all very much for your time.
Thank you, Ellen. And so here's, we will be sending out a follow-up email with information for everybody to have, hold on. We will be sending out an email with follow-up information for Alan, and thank you for everyone. I hear there's a Warriors game going on tonight, so thank you for being here with us. And there was a lot of information, so we will be, we do have this recorded, and we'll be posting it on our YouTube channel. Also, one thing that really hit me is that, you know, this thing about APRs, it was meant to make things simpler for people, and it actually, I think, got more confusing. So definitely talking to a loan agent that you can trust and being able to make these real comparisons and figuring out what's the best option for you is super important.